on at this point. We've also experienced the greatest infusion of rescue money that the world has ever seen, and this is money that did not exist. It's not like the U.S. and other central banks took the money out of some big pile of savings and put it out into the economy. The money didn't exist. We're already, remember, before this rescue, a massive debtor nation. So the result that we now face is that we have the greatest debt levels in world history, and we may or may not succeed over a longer period of time in revving up the economy. Clearly, in the short run, the vast amount of stimulus money that's been put in has succeeded in revving up the economy. The thing that's also fairly certain, unless we simply print away all of the debts, is that this debt will ultimately prove to be a drag on future economic progress. So we've willed something to our children and grandchildren, perhaps, that they won't really appreciate. So we bet our future generations' money on a rescue plan that may or may not work long term to solve problems that we caused. I think that's a very interesting moral question that we have to pose for, and that may get posed back to us by subsequent generations. The headline numbers that we all read in the financial press almost all point toward economic improvement, but there are certainly still some disturbing statistics that are receiving a lot less publicity. And I'll profile a few of those in the next couple of pages before we go to the technical side. This is by way of still putting us in a context in which the markets are moving. Personal income is declining. This is a Ned Davis graph, and you'll notice this form is a form of a number of the graphs we'll have in the book. This shows real personal income excluding transfer receipts perhaps being government payments for any number of sources. And I direct your attention to the bottom third of the graph here, and this shows on a percentage basis on this scale that you see the personal income has been declining at a rate of 4.4% year over year. Now that is a little bit surprising in light of the fact that we have had improving gross domestic product for the last couple of quarters, and everybody expects that it will be improving and not necessarily improving, but at least positive in the current quarter soon to come to an end. This is a result of what's seen on the next graph, and that is that payrolls haven't rebounded. What you're looking at here, this is a summary of the payrolls after an average of the last 6 post-war recessions. So what they did in this red line was say, okay, if we assume the recession ended here, after each of the last 6 recessions, here's what payrolls did. But the blue line is what's been happening in the current recession. And so again, if we assume that the recession ended at the end of June 2009, which is what most economists assume, we're not following the path of the recoveries after the last 6 recessions. We are, in fact, still losing payrolls, though they are expecting that we're going to start to see that thing turn up a little bit. But this has not been at least a typical recovery from the recession that we were in. And these data are confirmed by what we see on page 6, and that is tax receipts don't confirm the GDP growth. Remember, GDP was posted at 5.9% in the most recent completed quarter, and that's fourth quarter. Here are components of U.S. government receipts, year-to-year change, and I direct your attention to the top 2 of the bars here particularly. You have individual income taxes on the top one and corporate taxes on the bottom. And while taxes can lag somewhat due to such things as tax loss carry forwards and so on, individual income taxes have plunged by 22.4% year over year over the past year. And this graph is on data through February, you can see up in the upper right-hand corner, while corporate income taxes are off a whopping 52.4%. And these are not the kinds of numbers we should be seeing if this is really a healthy economic expansion. You should not be seeing tax receipts dropping at that, to the government, tax receipts dropping that fast. Production has clearly picked up. We're seeing that in the GDP numbers, but income is clearly lagging. And let me read a paragraph from The Economist magazine of roughly, I think it was 2 weeks ago, and it addresses the difference between the increase in productivity and this problem with income. And it says, a theoretically equivalent but less commonly cited indicator is gross domestic income as opposed to gross domestic product, which adds up wages, profits, and taxes. A growing body of research hints that GDI rather than GDP should be given more weight in computing an estimate of the economy's true direction. But by the light of GDI, the American economy looks a bit more pallid. In the third quarter of 2009, the most recent for which income data are available, GDI continued to contract while GDP notched up the increase that led many economists to announce the end of the recession. The picture painted by GDI throughout the downturn is one of an economy substantially weaker than indicated by GDP, one more in line with the employment data and with the experience of most Americans. Now, the next page also shows a phenomenon not seen in most economic reports. This is from David Rosenberg's economic report from Gluskin Sheff. Most business surveys we read or read about come from studies of very large companies, but most people in our economy work for small companies, and they don't typically get polled and included in the surveys to the extent that the large companies do. So these are two studies by the National Federation of Independent Businesses, and the one on the left is a business optimism index, and the one on the right shows companies, small businesses with one or more job openings. And very clearly, we are seeing an improvement in the statistics. You can see clear bounces off the bottom in both of those statistics. But the thing that's noteworthy, and this confirms what we're seeing in so many of the other statistics, is that while, and if you compute it on a percentage basis, this is a very nice bounce, and this is a little smaller over here. But in terms of level, if you look back across here, and this is a quarter of a century of data, we are at terribly depressed levels. In terms of job openings here, business optimism here. So we're not seeing anything yet that looks like this is a real sustainable recovery. Page 8 shows a consumer confidence survey. This Conference Board survey covers 5,000 households, and I would direct your attention to the red line here at the bottom of the graph, and you'll see this same pattern in most of the Ned Davis graphs we look at. The top half of the graph will show you stock market. Well, that's not what I'm really looking at. The purpose of virtually all of the graphs I'll put in here will be to study what they're showing here in the bottom half of the graph. And this shows that consumer confidence is not high. But the interesting thing is, when correlated with stock market performance, the stock market does better when consumer confidence is not high. It's like